Well, joining me now with more is Katie Stockton. She's founder at Fairlead Strategies and portfolio manager of the Fairlead Tactical Sector ETF, which trades on NYSE ARCA. Katie, it's great to see you.
You as well.
What's on your radar this morning as we begin the trading week?
Well, I think we're expecting increased volatility in general for the next few weeks. And referencing the VIX or CBOE volatility index, it does appear poised to rise above its 50-day moving average for a second time this month. That is a departure, of course, from the preceding 2 months. April and May were really very quiet in terms of volatility as the market rallied. But with June starting off with a pullback, we do think that risk is elevated of another pullback, maybe not a significant one, but a shallow one, to enter a more choppy phase for this market. We're also referencing in our work the 20-day moving average, which is a pretty tight trend following gauge. And it has flattened out for both the S&P 500 and the NASDAQ 100 indices. And that tends to be an environment that is characterized by more volatility than usual.
Interesting. Well, we do see the S&P 500 pretty close to a record high. I would say within striking distance might be fair. Of course, your firm has the TAC fund, the Fairlead Tactical Sector Fund, which trades on NYSE ARCA, as I referenced earlier. What does that give investors exposure to amid this market?
The TAC ETF is at heart a sector rotation fund. It uses long-term trend following gauges. And right now, it is 100% or nearly that exposed to equity sectors, but it does have the ability to move into alternative asset classes when the market warrants it. When we don't have 8 sectors, which we equal weight, checking all of our boxes in terms of the long-term trend following inputs that we use. The model-driven ETF, it will morph sort of into treasuries, both short-term and long-term, in addition to gold, to limit drawdowns when they do occur. So it's an adaptive way of investing in the broader market, but also with lesser exposure given its equal weight, sort of weighting to the technology sector. So it serves as a nice ballast for a portfolio that is technology heavy, of which many of them are these days.
Katie, you've been following markets for many years now with a lot of experience, and I know you referenced earlier that the indications are telling you that we could see some choppiness ahead and perhaps a shallow pullback. Is that consistent with what we typically see during these midterm election years?
Yeah, I think so. We don't cover the seasonality quite as closely because it doesn't inform our biases. We see it as more anecdotal than anything else, frankly. And we actually would feel the same way about historical correlations. We don't let them inform our views, but rather we look at trend following gauges, momentum indicators, overbought, oversold metrics, and relative strength inputs. And we just generally want to keep those on our side in our positioning. Technical analysis, I think, is seen as being very predictive, but in reality, it's a great risk management tool, and it can help us identify the prevailing trends, which are obviously higher right now for the equity market. We have the semiconductor sector continuing to be a source of upside leadership. Once that starts to falter, I think we're going to see a little bit of a correction from the broader market, but it doesn't show indications of that yet. So we are watching the SMH ETF for one, for indications of a significant loss of momentum, and that will then be a greater risk metric, calling for more than just a pullback perhaps for the S&P 500, but something more in the nature of a significant corrective phase. So we'll be watching those semiconductor stocks really very closely, more so than any cyclical inputs.
It's interesting, indeed, Katie. So are you anticipating a pickup in volatility if we do see that choppiness ahead?
Yeah, I think so. And again, we'll watch that semiconductor sector proxy for any indications of a loss of momentum to suggest that that volatility could be more severe on the downside. As it stands, we're referencing the 50-day moving averages for the major indices as initial support gauges. For the S&P 500, the 50-day is right at 73.15. So a pullback of that magnitude really wouldn't do any damage to the chart from a longer term perspective. In fact, I think it would be welcomed by the market as a potential entry point.
All right, Katie Stockton, founder at Fairlead Strategies and portfolio manager of the Fairlead Tactical Sector ETF. Katie, thanks so much.
Thank you.